There's a man on Wall Street who has made billions betting against the crowd at exactly the right moment. In 2009, when everyone was convinced the financial system would collapse, he stepped in and bought everything. That single trade made him $7 billion in 1 year. In late 2023, when pessimism gripped the markets and most investors sat paralyzed on the sidelines, he went on CNBC and told America to buy stocks aggressively. The rally that followed became one of the most powerful bull runs in modern history. His name is David Tepper, and for years he's been Wall Street's most reliable contrarian signal. When panic reaches its peak, Tepper buys. When euphoria takes over, Tepper sells. He doesn't trade on feelings or hunches. He trades on one thing and one thing only: liquidity. Where is the money flowing, and where is it about to dry up? So, here's why you need to pay very close attention to what I'm about to tell you. In his latest regulatory filing, the document that reveals exactly what hedge funds are buying and selling, David Tepper did something that should make every American investor sit up straight. While retail traders were piling into the market at all-time highs, celebrating gains and convinced the good times would roll forever, Tepper was quietly loading up on put options against the S&P 500 and the NASDAQ. He isn't just reducing his exposure to stocks. He isn't just taking some profits off the table. He is actively betting that our stock market is about to fall. Think about what that means for a moment. The same man who correctly called the bottom in 2009 and the rally in 2023 is now positioning his entire portfolio for a crash. This isn't some perma-bear on YouTube who predicts a collapse every 6 months. This is the hedge fund manager that other hedge fund managers watch for signals. Let me give you some context on why Tepper's track record matters so much. Back in late 2008 and early 2009, the world looked like it was ending. Lehman Brothers had collapsed. Banks were failing left and right. The S&P 500 had crashed nearly 60% from its highs. Every newspaper headline screamed disaster, and most investors had given up entirely. They were selling everything, moving to cash, and swearing they'd never touch stocks again. But Tepper saw something different. He understood that when the Federal Reserve opens the liquidity floodgates, when they start pumping trillions of dollars into the financial system, asset prices have nowhere to go but up. It doesn't matter how bad the news looks. It doesn't matter how scared everyone feels. Follow the money. That's the Tepper philosophy. So while everyone else panicked, he bought bank stocks, financial assets, anything that would benefit from the coming tsunami of Fed stimulus. The trade worked so spectacularly that he earned $4 billion personally in 2009 alone, making it one of the greatest single-year performances in hedge fund history. Fast forward to late 2023. The market had been choppy all year, and most investors were nervous about inflation, interest rates, and the possibility of recession. Tepper went on television and essentially told viewers to stop overthinking it. The Fed was done raising rates, liquidity conditions were improving, and corporate earnings were holding up better than expected. His message was simple: buy stocks now and ask questions later. Anyone who followed that advice watched the S&P 500 surge more than 40% over the following year. Now here's where this gets personal for you and me and everyone with a retirement account or investment portfolio. The 13F filing that hedge funds submit to the Securities and Exchange Commission. Every quarter is like a window into the minds of the smartest money managers in the world. You can see exactly what they bought, what they sold, and sometimes, if you read between the lines, what they're worried about. When Tepper's latest filing dropped, it revealed a dramatic shift that most financial media completely missed. According to the filing data, Tepper's Appaloosa management added significant put option positions against both the S&P 500 and the NASDAQ 100. For those unfamiliar with how options work, a put option is essentially a bet that the price will fall. It's insurance against a crash, but more than that, it's a way to profit from a crash if you buy enough of them. The fact that Tepper isn't just hedging, but actively building these short positions tells us something important about his current worldview. What makes Tepper different from most fund managers is his approach to analysis. He doesn't spend his days studying individual company earnings reports or debating whether a particular stock is overvalued by 5%. He's what's known as a macro trader, someone who looks at the big picture flows of capital and liquidity across the entire global financial system. When central banks are printing money and keeping interest rates low, Tepper knows that money has to go somewhere, and usually it flows into stocks and risk assets. When central banks are tightening conditions, pulling liquidity out of the system and raising the cost of borrowing, he knows that the fuel powering the stock market is being cut off. Think of it like a bathtub. The Federal Reserve controls the faucet, and when they're adding water, through low rates, quantitative easing, and emergency lending programs, the water level rises and lifts all boats. But when they start draining the tub, through high rates and quantitative tightening, everything that was floating starts to sink. Tepper has built his entire fortune on understanding exactly when that faucet is about to turn. So, what is he seeing right now that has him positioning for a downturn? The evidence suggests he believes we're approaching what traders call a liquidity cliff. Our economy has been running on the fumes of pandemic-era stimulus and artificially suppressed interest rates for years. The Fed raised rates aggressively to fight inflation, but the full impact of those hikes takes time to work through the system. The damage is coming. It's just been delayed. Here's the part that should genuinely concern every one of us with money in the market. Tepper's shift isn't subtle positioning around the edges of his portfolio. According to regulatory filings, he's making meaningful changes to his overall exposure, reducing positions in high-flying technology stocks, while simultaneously building bearish bets against the major indices. This is the behavior of someone who sees a fundamental change coming, not just a minor correction. You know how sometimes you sense a storm approaching before you see the clouds? The air feels different, the birds go quiet, and something tells you to head inside. That instinct has served humanity well for thousands of years. In financial markets, the smartest investors develop a similar instinct for trouble. They feel the shift in sentiment before it shows up in the headlines. They notice when the data starts diverging from the narrative, and they act before the crowd realizes what's happening. David Tepper appears to be heading inside right now. The man who told us to buy when everyone was selling has flipped the script entirely. And if his track record is any guide, we have perhaps the most reliable warning signal on Wall Street flashing red. The question you need to ask yourself is this: if the most successful contrarian investor of our generation is betting against the stock market at all-time highs, what does he see that the rest of us are missing? Because whatever it is, his portfolio suggests it's coming soon. And the moves he's making to prepare for it reveal a very specific kind of crash, one that most investors aren't remotely prepared for. Let's get specific about what David Tepper is actually doing with his money, because the details reveal a strategy most investors would find counterintuitive. When you dig into his recent SEC filings, you don't just see a man getting cautious. You see a man preparing for a very particular kind of market environment. And understanding his moves might just save your portfolio. Start with what he's selling. According to regulatory filings, Tepper has been systematically trimming his positions in the biggest technology names that have dominated this bull market. We're talking about NVIDIA, the chip maker that became the poster child for the artificial intelligence revolution. We're talking about Meta, the social media giant that reinvented itself around AI and the metaverse. We're talking about Microsoft, arguably the most important technology company in the world. These aren't small adjustments. These are meaningful reductions in his exposure to the stocks that every retail investor in America has been piling into. Now, think about what that means. These technology giants have been the engine driving our stock market higher for years. The so-called Magnificent Seven stocks have accounted for an outsized share of the S&P 500's gains. Every financial advisor, every robo-advisor, every target date retirement fund has been loading up on these names. They've become the most crowded trade in modern market history, and David Tepper is walking away from that trade. But here's where it gets really interesting. Tepper isn't just selling and sitting in cash. He's rotating that money into assets that most investors have completely written off. According to his filings, he's been building positions in regional bank stocks, the same sector that nearly collapsed during the banking crisis of 2023. He's also been aggressively buying Chinese equities, including significant stakes in companies like Alibaba, the e-commerce giant that has been absolutely hammered over the past few years. Pop quiz: if you had to choose between owning NVIDIA at all-time highs or Alibaba near multi-year lows, which would feel safer? Most people would instinctively say NVIDIA. It's the hot stock, the AI winner, the company that can seemingly do no wrong. But Tepper is making the opposite bet. and his logic reveals something profound about how professional investors think about risk. Here's the framework you need to understand. When a recession hits, and Tepper clearly believes one is coming, not all stocks fall equally. The companies trading at the highest valuations, the ones priced for perfection, tend to crash the hardest. Why? Because their stock prices have baked in years of future growth that suddenly isn't going to materialize. When expectations meet reality, the adjustment is brutal. Consider NVIDIA's valuation right now. The stock trades at multiples that assume artificial intelligence will transform every industry, and that NVIDIA will capture the lion's share of that opportunity for years to come. Maybe that's true. But what happens if corporate spending on AI infrastructure slows down during an economic downturn? What happens if companies start cutting their technology budgets to preserve cash? Suddenly, that sky-high valuation looks a lot harder to justify, and the stock has a very long way to fall. Now, contrast that with the beaten-down assets Tepper is buying. Regional banks have already crashed. Chinese tech stocks have already collapsed. The bad news is largely priced in. These aren't sexy investments. Nobody at a cocktail party is bragging about their Alibaba position right now. But that's precisely the point. When you buy assets that everyone has given up on, your downside is limited because expectations are already in the gutter. This is classic value investing applied at the macro level. Tepper is selling the overvalued winners and buying the undervalued losers, positioning for what traders call mean reversion, the tendency for extreme valuations to eventually normalize. If he's right about a coming recession, the high flyers could easily drop 40 or 50%, while his beaten-down holdings might actually hold steady, or even rise as central banks respond with stimulus. Let's talk specifically about his China bet, because it reveals something even bigger about his worldview. Tepper has been accumulating Chinese stocks at a time when most American investors won't touch them. Relations between our country and China have deteriorated. Regulatory crackdowns spooked foreign investors. Economic growth in China has disappointed. By almost any measure, this is the most hated stock market in the world right now. But Tepper sees something different. He sees a Chinese government that has finally started unleashing serious stimulus measures to support its economy. He sees valuations that have been crushed to levels not seen in decades. And perhaps most importantly, he sees a potential regime change happening in global markets, a shift away from American dominance toward a more multipolar financial world. Think about the implications of that trade. For the past 15 years, the winning strategy has been simple. Buy American stocks, especially American technology stocks, and ignore everything else. That trade has worked so well that most investors can't imagine any other approach. But Tepper is betting that this era of American exceptionalism in markets is ending. He's positioning for a world where the United States isn't automatically the best place to invest. Whether you agree with that thesis or not, you have to respect the courage it takes to make that bet. Tepper is essentially saying that the consensus view that American tech stocks are the only game in town is about to be proven spectacularly wrong. He's putting billions of dollars behind that conviction. The rotation in his portfolio tells a coherent story. Sell the crowded trade, buy the abandoned trade. Sell the assets priced for a perfect world, buy the assets priced for disaster. Sell American tech exceptionalism, buy Chinese recovery. Every move points in the same direction. Tepper believes the market regime that has defined the past decade is ending, and a new one is beginning. What makes this particularly urgent for you and me is that most of our retirement accounts, our 401ks, our index funds, they're all massively overweight the exact positions Tepper is selling. We've been conditioned to believe that buying and holding the S&P 500 is the safest long-term strategy. But if Tepper is right, that strategy is about to deliver some very painful lessons about what happens when the tide goes out on a crowded trade. So we've seen what David Tepper is doing with his portfolio. We've seen him dump the technology darlings and rotate into beaten-down value plays. We've seen him build short positions against the very indices that most Americans have their life savings invested in. But the real question is why? What specific scenario is he positioning for? And when does he expect it to arrive? The answer lies in understanding what Tepper believes is the Federal Reserve's biggest mistake in years. And once you see the logic, you might find it hard to sleep soundly knowing how exposed your portfolio really is. Here's the core thesis. The Federal Reserve raised interest rates at the fastest pace in 4 decades to fight inflation. They took rates from essentially 0 to over 5% in roughly 18 months. That's an extraordinary amount of monetary tightening in a very short period. And while inflation has come down from its peak, the full impact of those rate hikes hasn't finished working through our economy yet. Think about how monetary policy actually operates. When the Fed raises rates, it doesn't immediately crush economic activity. There's a lag, typically 12 to 18 months, before the higher borrowing costs fully ripple through the system. Companies that locked in low rates years ago are only now facing refinancing at much higher levels. Consumers who were insulated by fixed-rate mortgages are seeing the effects in credit card debt, auto loans, and reduced purchasing power. The damage accumulates slowly, then arrives all at once. Tepper appears to believe we're approaching that inflection point right now. Look at the data that's been trickling in over recent months. Unemployment has been creeping higher. Manufacturing surveys have been contracting. Consumer confidence has been weakening. Credit card delinquencies are rising. These aren't signs of a booming economy. They're signs of an economy that's starting to crack under the weight of restrictive monetary policy. And here's the cruel irony that Tepper understands better than almost anyone. By the time the Federal Reserve recognizes the damage and starts cutting rates aggressively, it's usually too late. The recession is already baked in. The layoffs have already started. The corporate defaults are already happening. Rate cuts can't instantly reverse months of accumulated economic damage. This is exactly what happened in 2008. The Fed started cutting rates before the crisis, but the cuts couldn't prevent what was already in motion. Now let's talk about what this means for stock prices, because the math is genuinely sobering. The S&P 500 currently trades at around 22 to 25 times earnings, depending on which measure you use. That's a historically elevated multiple, justified only if you believe corporate profits will continue growing strongly into the future. But what happens if we get a recession instead? During a typical recession, corporate earnings fall by roughly 15 to 20%. Companies sell less, profit margins compress, and the bottom line takes a hit across nearly every sector. That's just what happens when economic activity slows down. So let's be conservative and assume a 15% decline in S&P 500 earnings. But here's where it gets worse. When earnings fall, investors don't just reprice stocks for lower profits, they also pay a lower multiple for those reduced earnings. Why? Because uncertainty rises, risk aversion increases, and the confidence that powered the bull market evaporates. In past recessions, the S&P 500's price-to-earnings multiple has typically compressed from the mid-20s down to somewhere between 15 and 18 times earnings. Let me walk you through the calculation that keeps value investors up at night. If S&P 500 earnings drop 15% and the multiple compresses from around 24 to around 18, both entirely reasonable assumptions for a recession, the index would fall to somewhere around 4,000 to 4,200. That's roughly a 30% decline from recent highs. And if the recession is worse than expected, if earnings fall 25% and the multiple drops to 15, you're looking at the S&P 500 closer to 3,200. That's a 40% crash. This is the air pocket that Tepper's put options are targeting. He's not betting on a garden variety pullback of 5 or 10%. He's positioning for a genuine bear market, the kind that wipes out years of gains in a matter of months. Now, remember those regional bank stocks Tepper has been buying? This is where his strategy becomes almost elegant in its logic. Regional banks were crushed during the 2023 banking crisis when Silicon Valley Bank and several others collapsed. The sector has been left for dead, with many stocks still trading well below their pre-crisis levels. Most investors see these as damaged goods, relics of a financial system that nearly broke. But Tepper sees something different. He sees assets that are too important to fail. When the next crisis hits, and he clearly believes it's coming, regional banks will likely face renewed stress as commercial real estate loans go bad and consumer credit deteriorates. But here's the key insight. The government will have no choice but to step in and support them. We saw this playbook in 2008 and again in 2023. When the banking system is threatened, the Federal Reserve and Treasury Department will do whatever it takes to prevent a systemic collapse. Tepper is essentially buying a put option on government intervention. He's accumulating assets that he believes Washington must rescue, while simultaneously shorting the assets, like high-flying tech stocks, that will be left to fend for themselves. In a crisis, nobody is bailing out Nvidia shareholders, but bank depositors and the financial system's plumbing, that's a different story entirely. This brings us to the timeline that should focus your attention. Economic data typically deteriorates with a lag after monetary tightening. The rate hikes that started in 2022 and continued through 2023 are only now fully hitting the real economy. If Tepper's analysis is correct, the visible cracks we're seeing today in employment and consumer spending will widen significantly over the next 6 to 12 months. That puts the most likely window for a serious market decline somewhere in 2026. Of course, no one can predict exactly when markets will turn. Tepper might be early. He's been early before and still made money because he was ultimately right. But the setup he's positioning for, a recession caused by over-tightening, leading to an earnings collapse and multiple compression, is a thoroughly researched scenario with historical precedent. This isn't some fringe theory. It's what happens when central banks tighten too much for too long. So, what does this mean for you? First, understand that Tepper's track record demands respect. This is someone who has made billions by correctly reading macro conditions when the crowd got it wrong. When he makes dramatic portfolio shifts, it's worth paying attention. Second, take an honest look at your own portfolio. How much of your wealth is concentrated in the same crowded trades Tepper is exiting? How would you feel if the S&P 500 dropped 30% from here and stayed down for 2 or 3 years? Most investors haven't stress-tested their portfolios against that scenario because the past 15 years have conditioned us to expect stocks to always come back quickly. Third, consider whether some hedging makes sense for your situation. You don't have to go full Tepper and start buying put options. That's sophisticated stuff that can lose money quickly if the timing is wrong. But raising some cash, diversifying internationally, or simply reducing your exposure to the most overvalued sectors might help you sleep better if his thesis proves correct. There's an old saying on Wall Street, don't fight the Fed. When the central bank is pumping liquidity into markets, you want to own stocks. When they're draining liquidity, you want to be cautious. Tepper built his fortune following this principle, and right now, his read on liquidity conditions is decidedly negative. But perhaps we need a new corollary for our times. Don't fight David Tepper. When the man who called the bottom in 2009 and the rally in 2023 suddenly reverses course and starts betting against the market, that's not random noise. That's a signal from someone with a multi-billion-dollar track record of being right when it matters most. The bull who correctly predicted this rally has officially left the building. He's not just stepping aside, he's locking the door behind him and positioning for what comes next. The easy money era that defined the past 2 years appears to be ending. Whether you choose to act on that information is up to you, but at least now you can't say you weren't warned. The smartest macro trader of our generation just told you exactly what he thinks is coming. The only question is whether you'll listen before the crowd figures it out.